minus basically 1 minus 0.75 means that we have an effective tax rate of 25%. Okay? So all this is doing is basically saying what is the difference, if you will, between our before tax cash flow and our after tax cash flow, and coming up with what is the effective tax rate that we're really truly paying on that income. Does that make sense? Yes or no? Okay, so simple little calculation and to kind of help us out there. Okay.
Oh,
Yep.
the 1.75
Was not 1.75, it's
0.7.
0.7. In other words, 15% divided by 20% is 0.75. And then 1 minus that, 25%. Okay. All right. Okay, one more thing. All right, so let's say that for this property that's $1 million, that we get an $800,000 loan. And that loan is for 15 years at a 7.5% interest rate, and we need to calculate the payment and then ultimately calculate the interest for year 1. Okay? So, to do this on the calculator, 12 payments per year, 800,000 is our present value. 15 shift in is our term. 7.5% is our interest rate. Let's solve for the payment. And you get 74.16 and 10 cents. All right. Now, that is just that's our monthly payment. Now what we have to do is we have to figure out how much of that is interest, how much of it is principal. So we use the amortization function. And so we want to find out for the first year or the first 12 months. So we do 1 input, 12, shift, amortize, and then equal, equal, and equal. All right? When we do this, we get our principal of $30,010. We hit equal again, and we get the interest, which was $58,982. We hit equal again. We get the balance of $769,989. The number that we are searching for is the interest piece, okay? So that would be the number that we would insert back into our calculations to come up with what is our interest expense for that period of time. Does that make sense? Okay, in this case, for the first year. All right. I think, let's double check. We talked about the amortization of points earlier. Okay, and we know how to do, obviously, internal rate of return and net present value, so we're good with that. All right, so I think the only final piece of information, and then we can do the quiz. And this will go pretty quickly, hopefully. The mid-month convention. Okay, so this is the last piece and then quit. We hope to get through this in the next couple of minutes. Okay, you remember what we talked about, that each year you have a depreciation amount that you get to claim from the IRS, that you get to deduct, you know, from your net operating income to ultimately come up with income taxes paid. Yes? Remember that. Okay. Now, one of the things that matters is when, over the course of the year, did you acquire the property? Did you acquire it January the 1st? Did you acquire it June the 1st, June the 15th, April the 24th? Whatever day and month that you acquired it, you need to be aware of that, because that's going to make a difference into how much depreciation you're going to be able to claim for the first year of acquisition. The IRS makes the assumption that regardless of when during the month you acquired it, they make the assumption it was acquired in the middle of the month or on the 15th of the month. Thus the term mid-month convention. So if you acquired a property on January the 1st, okay, the IRS is saying for their purposes, they're making the assumption that you acquired it January the 15th, which means that you only get 11 and a half months worth of depreciation. Now, why do they do this? Well, believe it or not, it was meant to be for simplicity, okay? And because most assets with the IRS, they may just simply make the assumption that it's a mid-year convention. Those of you that have taken probably principles of accounting at some point in your history, and you did modified accelerated cost recovery systems and all that sort of stuff in accounting, one of the things that they typically do is that first year, regardless of whenever you acquire the asset, the IRS makes the assumption that you acquired it literally 6 months into the year. So you get half a year of depreciation for that first year. Well, what does that motivate companies to do? Buy all of their assets at the end of the year, that way they get a free 6 months of depreciation. Okay, with real estate, because it's a mid-month convention, that is why so many closings occur when? End of the month. Okay, so that they effectively get a half month of free depreciation, if you will. All right, so put it simply, if you acquire a property in January, you get 11 and a half months of depreciation. February, March, April, May, June, July, August, September, October, November, December. So very simply put, you probably need to make one of these little schedules. It's very simple. Just goes down by half a month each time. Okay? So, in essence, if you were to acquire a property on December the 31st, how much depreciation are you going to get? Half a month. Does that make sense? Okay, if you acquired a property today, May the, whatever it is, 28th, okay, May, you get 7.5 months of depreciation. Does that make sense? Now, how do you get there in terms of the calculation? The simplest way to do it is to say, okay, if my depreciation amount is $30,000 for the year, okay, then I would simply take that and multiply it by whatever the month is. So in the case of May, it's 7.5. All right. So you would simply take 7.5 divided by 12, which would be 0.625, and multiply that by that depreciation amount, and that would give us $18,750 of depreciation for year one. Okay? Now each subsequent year is going to be the full $30,000, but because the property was acquired and placed into service in May, then you're only going to get this amount of depreciation for this year. Make sense? Any questions on that? Okay. think that should take care of everything.
Did you,
So even if you purchase something at the end of January, you would still get 11.5?
That is correct. That's the term, mid-month convention. Everything from the IRS's perspective occurs on the 15th of the month.
Just go by the first of the month.
Right. The perfect time to buy is the end of the month. Okay?
What do you got on the 30,000?
$30,000 a year. $30,000 a year for your depreciation, and we're simply saying you're going to get 7.5 divided by 12, or 62.5% of that if you buy it in the month of May, or that amount for that year it was placed into service. Okay? Make sense?
I mean, what is the start?
What do you mean?
The start number is just 11.5. That's
Well, yeah, because once again, okay, how many months are there in a year?
what?
12. Okay, if you get half a month of depreciation in January, okay, how many months do you have left? 11 and a half. Okay. All right. Any other questions? Final last call.
Just quickly.
I got one for the previous problem.
Okay. What is it, Quincy?
Make sure my stuff wasn't.
Can you share the notes? We have some technical difficulties with
I can try. I'm not promising, because sometimes it works and sometimes it doesn't.
Okay.
Okay, all right. Final last call.
So as far as the CapEx and everything like that, even when you're putting that into your bottom line and everything, that just goes right, almost like another bullet point for the, in the depreciation?
Yes, it would be part of that depreciation amount. Yeah. Okay. See.
That 30,000, the last problem, that was the total depreciation per year?
Yeah, and that was just a made-up number. I just pulled it out of the air.
Okay, it wasn't per question, anything, just.
Yeah. Okay. Okay. All right. Let's do the quiz. Okay. Once again, the quiz is open book, open notes, open computer, not open neighbor. Okay. All right. And you've got until 10:15 to do this. And I will be handing out an answer sheet.
I'll say I'll put 20 bucks on it, 20 cents for the notes.
Well, it's open book, open notes.
yeah, except mine was kind of stuck at tax at 25%.
You can look it up.
Yours.
Well, no, I mean, your notes, not my notes. Okay, let me get you an answer sheet. Sorry, what? It's either or, it's either going to be 12 or 1, but it's going to be depending on what the problem is.